Learning objective B, prepare appropriate consolidation journal entries to eliminate the effects of intragroup transactions and balances. And this will be pretty much where the bulk of the work is done in this topic. So there are 6 types of intragroup transactions that we're going to look at here. The first one being intragroup services, then intragroup sales of inventory, then intragroup sales of depreciable assets, then transfers of inventory to be used as a non-current asset, then intragroup borrowings, and finishing up with intragroup dividends. And that's a payment of an intragroup dividend from post-acquisition profits, not the dividends we were looking at in topic 3, which is whereas an ex-div or cumulative dividend. So first on our list is intragroup services, and these are the simplest type of intragroup transaction to eliminate. They create items of service revenues and service expenses in the accounts of the respective entities in the group, and can include, say, a rent of a premises or equipment, management fees, or provision of a specialist service from one entity to another. It doesn't matter whether the parent or the subsidiary are providing the service, the consolidation journal entry will still be the same. One of the reasons this type of transaction is so easy to eliminate is there's no tax effect adjustments to make in this type of transaction, as no adjustments have been made to between, say, the statement of comprehensive income and the statement of financial position accounts, so there's no temporary difference between accounting and tax. So we'll go over to the next slide now and we'll look at an example. So as it reiterates here what I talked about, the intragroup service creates a service revenue in one entity and an expense in the other, and they need to be eliminated to ensure that revenue and expenses are not overstated within the consolidated accounts. Quite often in a group, one entity, say the parent, provides a service such as either the accounting, HR, IT to the other entities, which are the subsidiaries, and it reduces duplication. And the provider normally charges a management fee to the user, and this must be eliminated. So an example, if the subsidiary rents a premises from its parent at $30,000 per year, the consolidation journal entry to eliminate the intragroup rent would be a debit to rent income and a credit to rent expense for that $30,000. In some cases, intragroup services may also result in an account balance adjustment within the statement of financial position. Say there was rent paid in advance, there would need to be a additional consolidation entry, say, to debit unearned rental income, which would be a liability account that would be eliminated, and then the other side, the prepaid rent account, which is normally an asset, so a debit balance, that would be a credit, and there would still be no tax effect to record there. Moving on to the second type of intragroup transaction, which is the sale of inventory. Alright, so when inventory is sold on an intragroup basis, there's 3 possible adjustments. So 3 different scenarios. The first one, sales and purchases, which is the easiest. So if the intragroup sale of inventory is sold during the period to an external party, so it's transferred from parent to subsidiary, then it's all sold within the same period, the only requirement would be to eliminate the intragroup sale. So all you'd need to do is debit sale, credit cost of sale for the intragroup transaction amount. No tax effect to consider and no adjustment to the inventory account. Nice and simple. However, quite often the second or third event occur, being profits in ending inventory, meaning there's been a transfer of inventory from one entity to another, and that's either all of it or some of it is still on hand at the end of the period. Or point 3 there's profits in opening inventory, which is in the prior period there was a transfer of inventory and it's still on hand in the current period. So we're going to look at 2 and 3 over the next few slides, and just so you're aware, this text uses the perpetual system for accounting for inventory. We don't use the periodic system, and you may see that in some other textbooks, but for the prescribed text, company accounting, we will be using the perpetual system to account for inventory. So let's look at this example of a sale of inventory within an economic entity to try and add some context to what's going on. So we have an external supplier selling inventory to a subsidiary for $100 on the 1st of June 2016. So that goes into the subsidiary's account, so that's fine. However, within that same reporting period, 25th of June 2016, that is sold to the parent for $150. So there's a profit there we can see of $50 within that intragroup transaction. And then it says below the parent that all inventory was still held by the parent as at the 30th of June 2016. Okay, so that $50 of profit has not been realized outside of the group, so this needs to be eliminated within the consolidated accounts. So this slide is just going into a bit more detail about what I was talking about on the previous slide. So same example, the subsidiary would have recorded a sales amount of $150 and a cost of goods sold of $100, and the remaining amount would be considered profit of $50. This $50 made by the subsidiary is considered unrealized as it's not sold to an external party, and we would need to make some adjustments so that's not recognized within the consolidated accounts. On the parent side, they would have recorded inventory as $150, an increase in the balance, and that's considered overvalued. So it's fine for inventory to go from the subsidiary to the parent at $100, there's no issue there. However, that $50 increase, that needs to be decreased back down to its original cost amount. So on the next slide we'll show you what's happening in the respective parent and subsidiaries accounts to give you an idea of what actually needs to be eliminated from each of those transactions. However, just one other point I wanted to make, you may think it would be easier and simpler if inventory was just transferred between entities at cost, and why worry about adding this profit in when it's just going to be eliminated when the consolidated accounts are prepared. However, this quite often happens, and that's because separate entities operate within their own performance measures, meaning that a sale with profit is within their interest, even though it creates all this work for us as accountants. Here we have the subsidiary and the parent's entries listed side by side in relation to this event. So first we've got the 1st of June where the inventory was purchased from an external party, so we've debited inventory $100 and credited accounts payable, or it could be cash, $100 there. Then on the 25th of June we've got the intragroup transaction, and that involved a debit to cash and a credit to sales to record that within the subsidiary, and then over here we've got a credit to cash to pay that amount over to the subsidiary. And then we've also got this credit to inventory because that's no longer within the subsidiary's possession, and it's valued at $150 over in the parent's accounts. And then a debit to COGS. We've also got this income tax expense debit 15 and credit current tax liability to, and the reason that's $15 is there's a $50 profit from the intragroup transaction for the subsidiary, so they're recording that 30% tax on that. Now, just so you're aware, this entry is usually not recorded until the end of the reporting period, which is where the current tax worksheet's prepared that we looked at in topic 1, but just for explaining what's going on here, we've included this transaction at the 25th of June. So there's a few adjustments that will need to occur because of these entries for intragroup for consolidation purposes. So firstly, it doesn't matter that cash has simply changed hands from the subsidiary to the parent. It's still $150, so there's no elimination that needs to occur there. Now with this sale of $150, that will need to be eliminated because that's increased the sales account by $150 and it's not realized externally outside of the group. Same with this COGS amount, we'll need to reverse that. That can't be recognized within the consolidated accounts. And the profit, which was $50, the difference between these two, we'll need to eliminate that as well. And that will be done via these two entries. However, our debits and credits need to balance, and we need to reverse this inventory from $150 down to its cost amount external to the group, which was $100. So the final entry here will be a credit to inventory of $50 to reduce that down to $100. And here we have the consolidation entry that I discussed on the previous slide to record the elimination of the intragroup transaction: a debit to sales of $150, credit to COGS $100, and a credit to inventory for $50. And so this credit to inventory will eliminate the full effect of the unrealized profits on the internal sale of inventory, as from the consolidated point of view there's no sale and no COGS. And we also need to reduce the inventory down to 100. And we've done all that via this entry. There's one more consolidation entry we need to record, and that is to recognize the tax effect because we're decreasing the carrying amount of inventory by $50. So to do that, we would debit deferred tax asset by $15 and we would credit income tax expense by $15. As from a group's viewpoint, there's no profit and there should be no tax expense. So the relevant tax expense will be recognized in the future when the inventory is sold by the parent to an entity outside of the group, and that will be made up of the income tax expense recognized by the parent plus the reversal of the deferred tax asset recognized above. So as we looked at on slide 15, that debit to income tax expense $15 and credit to current tax liability within the subsidiaries accounts of $15, because that's been recorded in the current period, but then in the future period is when the inventory is going to be sold by the parent. From a consolidated point of view, that $15 has already been paid. So yeah, from a consolidation point of view, it's a future tax asset to the group. Here we have an extract of a consolidation worksheet for both the statement of financial position and the statement of profit and loss. And as you can see here in the adjustments columns, we've placed the consolidation entry prepared on slides 16 and 17, and you can see how from a group's viewpoint the inventory is reduced now to 100. There's a deferred tax asset account now recognized, and there's from a group's viewpoint no sale, no COGS, no gross profit, and no tax expense recognized. And that's how it all comes together. So from a group's viewpoint there was no transaction at all, and if this was the only transaction that occurred between the parent and this is the only transaction that occurred for either the parent or the subsidiary, from a group's viewpoint there would be no revenue or expenses to record. In the example we just looked at, none of the inventory that was sold from the subsidiary to the parent was subsequently sold external to the group. However, quite often at least a partial amount of that inventory is sold, and when that occurs your entries will change slightly, because we're only needing to eliminate the amount that's still on hand at the end of the reporting period. So for example, say 40% of the inventory is still on hand at the end of the period, meaning 60% has been sold during the period. If that was the case, the adjustment entry would change to the following. We'd have a debit to sales of $150. So that hasn't changed from before, whether all the inventory is sold or none, or just a partial amount. You'll still debit the sales figure by the full intragroup transaction sales amount. However, the next two entries, we're only crediting COGS $120, and we're only crediting inventory for $30, and that's changed from the previous example. We had $100 for COGS and we had $50 for inventory. So with inventory, when I'm actually doing one of these questions, I would probably figure out what the inventory amount is first after sales, and what's happened there is there's 60% still on hand, so I would go the profit amount of $50 times that by 60%, which equals $30, and therefore that would be my credit balance, and the difference between the two would be the COGS, which is therefore 120. However, to actually calculate what the COGS figure is, we would go the $100 if none of it was sold, plus the parent's portion of $60. The $60 is calculated by $150 times 40%. So that means within the parent and subsidiaries accounts they've got a total of $160 recorded for COGS. However, from a group viewpoint, the COGS should only be $40, which is $100 the cost from the external party, from the subsidiary originally, times 40%, which is the amount sold externally. So that so to get that back down from 160 to 40, we need to credit COGS $120. We also need to account for a tax effect as well, and we'll look at that on the next slide. And here we have the entry to record the tax effect for this transaction where 40% is sold externally and 60% still on hand. So instead of recognizing $50 times 30%, we're only going $30 times 30%, which equals $9, but the actual entries stay the same. How I always remember what the amount is to record for the tax effect of an intragroup transaction that involves inventory, I just get whatever the inventory balance is and multiply that by 30% from my previous entry, and that equals what the deferred tax that needs to be recorded is. So there's a bit of an explanation on the second point here, saying that if, from a group's viewpoint, the profit was only $60, which is the sales amount of 100 less the COGS of $40, which we calculated on the previous slide. So the income tax for the group should only be this $60 times 30%, which is $18. So we have $15 recognised in the subsidiary and $12 in the parent. So to get this down to $18, we need to take 9 off, and that's our elimination amount. And the balance in the deferred tax asset will be reversed in the period in which the remaining 60% of inventory is sold by the parent to an entity outside of the group. Now looking at another type of adjustment with inventory, which is where there are profits in the opening inventory. And what's going on in this type of adjustment is in the previous period there was profits in the ending inventory, and then in the current period that we're preparing the consolidated accounts for, that inventory is now sold in the current period. So there's still an adjustment that we need to do in this period, because we need to eliminate the opening balances profit and tax effect adjustment. And we can assume that the profit will become realized when the inventory is sold to the external party in the next year, because inventory is a current asset, and unless specifically told otherwise, it should be sold within 12 months of being acquired by the group. So the opening balance of inventory will be overstated if an adjustment's not made, and these journal entries will be different if the inventory is transferred in a prior period and not sold within the current period. So the retained earnings account will be involved for these transactions. So instead of using the profit and loss accounts we used in that previous example, this one will be dealing with retained earnings instead for those accounts. Going back to our original example on slide 13, when we were focusing on profits in closing inventory, the events were that on the 1st of June an external supplier sold inventory to the subsidiary for $100, and then on the 25th of June the inventory is then sold to the parent for $150, and the parent still had that on hand as at the 30th of June 2016. So that's where we're up to. Now we're going to look at the next financial reporting period, 30th of June 2017, within that period, and what we're saying is on the 30th of July 2016 the parent sells 100% of the inventory for $175. And now on the next few slides we're going to look at how we account for that. So recall that the worksheet entries, the consolidation entries that were recorded as at the 30th of June 2016 were debit to sales, 150, credit to COGS, and a credit to inventory. So we brought the inventory back down to $100 and we reversed the revenue and the expense, bringing that, which effectively eliminated that profit. And we also accounted for the tax effect via the deferred tax asset and income tax expense entry there. So if we were to carry forward the net effect of last year's consolidation journal entry, and just as an example, say the following day we prepared consolidated accounts, which we don't do, but just to explain what's going on here. So as at the 1st of July 2016, if we were to prepare the accounts and that inventory was still on hand, we would instead prepare the following entry. We would debit retained earnings for $35, which is that $50 profit less the $15 tax effect. So that entry replaces the sales and the COGS entry that we did previously, and it takes away the income tax expense entry as well. So if you look at the above entry, it effectively, the retained earnings account entry there is all the income and expense items put together as a net figure. So if that helps you remember what that entry is made up of, it's all the income and expense, or revenue and expense, means the same thing, different word, items put together. And if you have a look at these other two entries, the deferred tax asset and their inventory account, they've stayed the same. Why? Because they're statement of financial position accounts and they don't change. So we've still got that debit DTA 15 and credit inventory 50, and this entry is not very common. Usually the inventory, as mentioned on the previous two slides, it's sold within 12 months. That's the expectation because it's a current asset. But this is just to exemplify what's going on if the inventory was still on hand and we needed to prepare a consolidation entry to eliminate that. So once the inventory is sold to an external party outside of the group, the profit is considered realised, and the consolidation journal entry we prepare as at 30th of June 2017 would be again a debit to retained earnings of $35. No change there as to whether it was sold or not. Now we've got a debit to income tax expense $15 and a credit to COGS $50. And this entry wouldn't be required in future periods as the profit's now realised and no further action is required in the future. So looking at these, the second and third entry there, the COGS, because when the parent sold the inventory they would have debited COGS $150. So by crediting COGS $50 we're reducing it back down to $100, and the income tax expense is related to the tax effect now realised. So this has changed slightly than if the inventory wasn't sold. And one last thing I just want to mention is just remember we're preparing notional accounts here. So when we're preparing the accounts as at 30th of June 2017, nothing that's been previously entered is there. So that debit to sales, credit to COGS, credit to inventory, debit deferred tax asset, credit income tax expense, that when we're preparing the 30th of June 2017 accounts, it's not there anymore. We're preparing these accounts on top of the parent and subsidiaries accounts, so that's why we're again doing these entries as at the current period. Okay, so we're going to move on to the third type of intragroup transaction we look at in this topic, which is an intragroup sale of depreciable assets. So if a non-current asset, say property, plant and equipment, is sold on an intragroup basis, the consolidation adjustments are required to firstly eliminate the profit or the loss on the sale. Usually, or most examples are at a profit, but it could be a loss in some cases. And this is a similar principle to what you applied for this intragroup sale of inventory when adjusting for the change in value of the asset. And then the second point here says you've got to also restate the depreciation. So most of the examples we give you that involve property, plant and equipment are depreciable, and therefore you need to adjust for the depreciation effect as well, and that changes depending on how many periods have lapsed since the intragroup transfer occurred. So let's look at an example now where the subsidiary purchases a machine externally for $100 on the 1st of July 2016, and they depreciate this asset at 10% per year. Then at the end of the reporting period, 30th June 2016, it's sold to the parent for $150. And the tax rate, which we could already assume is 30%, but it's stated here. And so that's the situation, and we're going to look at, on the next slide, the journal entries processed by each respective entity, the parent and the subsidiary. And then we'll look at what consolidation adjustment is required after. So looking at the individual transactions that occurred within the subsidiary and the parent's accounts, initially we've got this recognition of the asset via debit to machine $100 and a credit to cash $100. Then at the end of the reporting period, the subsidiary records the depreciation due to owning that machine for a year. So the depreciation rate was $10, no 10%, so $100 times 10% equals $10. Then at the end of the reporting period we've got here a debit to cash $150, and then corresponding with that's the credit to cash $150 within the parent. Then to account for the sale we debit accumulated depreciation $10, which reverses this account. Then we've got the credit to machine $100, which reverses this initial account here. and then the balancing entry is the credit to gain on sale here. We also have this credit to tax current tax liability here of $15, which is the $60 gain less the $10 depreciation expense. So that's $50 times 30% equals 15. And like I mentioned with this previous example where we had the parent and subsidiaries accounts lined up, we don't usually record this until the very end, where we prepare our current tax worksheet and record the current tax liability for the year in one journal entry. But this is just for illustrative purposes that we include it now. So for consolidation purposes, what we need to reverse is, firstly, the machine's now recognized at $150. However, externally we only paid $100 for it, so for consolidation purposes we need to reverse that down to $100. And as well as that, we would need to reduce the gain, because from a consolidated point of view there is no gain to account for. And then in future periods, say 2017 onwards, we're going to also need to consider depreciation as well. I think I mentioned this in the previous example, but I just want to make it absolutely clear again. Because cash has just changed hands from the parent to the subsidiary, there's no actual consolidation adjustment required, and parent can change. It's just cash changing hands. So from a consolidated point of view, there's no overstatement in that respect. So that's why there's no cash to adjust. So rule of thumb: whenever you're preparing consolidated accounts, you should never ever be touching the cash account. Okay, cash doesn't change value, so it never should be touched. So rule of thumb: never ever debit or credit cash when you're preparing the consolidated accounts. So now talking about the consolidation journal entry adjustment we need to prepare. Well, firstly, at 30th of June 2016, we'd need to eliminate that gain on sale I mentioned before. So we would debit the gain on sale $60 and credit machine $60. So that will bring the asset back down to $90. So from the group's perspective, we paid $100 for the asset, so that we would reduce it back down to $100, you would think. However, we've also got to account for 1 year going by and it being depreciated $10. So the actual carrying amount from a group's perspective is $90. So this entry here brings it back down to $90. And we've also got to account now for the tax effect, because in the subsidiaries accounts they would have recorded the tax on the sale to the parent. However, from a group's perspective, that's created a deferred tax asset of this $60 difference. So multiplying that by the 30% tax rate equals $18. So that entry is also recorded. Now looking at an extract of a consolidation worksheet with the journal entries we've prepared so far. So we've adjusted the machine from $150 within the parent's books down to $90, and we've also accounted for the deferred tax asset tax effect due to that reversal of the gain. We've also reversed the gain completely, and we've still accounted for $10 worth of depreciation that is realized, and also due to that there is 30% of $10, which is $3. That is an income tax expense deduction. You can take that off the income tax expense. That's why it's a credit balance there, as depreciation is an expense, and that means there's less tax to pay on it. Sorry, I just thought I should mention that on the previous slide, that was learning objective C, and which is to prepare consolidation worksheets and financial statements excluding consolidated statement of cash flows that incorporate intragroup transactions. We do learning objective C via the tutorial questions. They're quite large in that they take up a bit of space, and it's difficult to put these within the PowerPoints. Anyway, the consolidation worksheets are quite practical, so I just thought I should mention that. That's why we don't spend too much time on them within the lecture slides. So anyway, back to this slide now. Looking at the depreciation on the transferred machine. So the parent, being the purchaser, will depreciate the asset at a different rate and a different amount rather, than the subsidiary would. And so we've got this table here which has the subsidiary and the parent listed side by side and the difference between the two in their rates of depreciation. So in this first row it says that the written down value, WDV, as at the date of transfer for the subsidiary was $90, but the parent is now recognizing $150 on the machine. So we've got a difference there of $60, and we're already aware of that from the previous slides. And the remaining useful life is 9 years, because it was originally 10%, so 10% times 10 is 100%, so 10 years, 9 years remaining, fine with that. However, the depreciation charged will change now. So applying 10% on $100, which is what the subsidiary paid for the asset, is $10 a year. However, the parent, over the next 9 years, applying the 10% depreciation rate equals $16.67. So there's a difference there of $6.67 each year. So on consolidation, it's necessary to reduce the depreciation by this difference amount back to the original cost of the asset to the group, and we need to account for the related tax effects associated with removing the unrealized gain. So in summary, we need to reduce the depreciation back to what it originally cost outside the group, and there's quite a number of journal entries to prepare depending on how long it is since the asset was transferred. So remember, in the year of the disposal, 30th of June 2016, the consolidation journal entry we prepared to reverse this transfer was a debit to gain on sale $60, credit machine $60, and account for the tax effect. In the subsequent years, say 30th of June 2017 and onwards, as long as the assets within the group, we would prepare the following entry. We would debit retained earnings $42, and if we have a look up above, the same principle that applied to inventory applies here, where if we take the income and expense account, so that $60 gain on sale less the income tax expense of $18, that equals $42. So that's what that account is in relation to. It's in relation to the prior year income and expenses. Then we've got this deferred tax asset, which is just recognized again because it's still within ownership. It's a deferred tax asset of the parent. And then we've got this credit to machine of $60, which brings the machine back down to its $90. As at the date it was transferred, it had a carrying amount of $90. So it says in this pop-up box here that it's the deferred tax asset which is credited, not the deferred tax liability, as the entry is realized as part of the unrealized profit through the use of the asset. So this entry would just be prepared each year thereafter, in the period post transfer. However, say 30th of June 17, and this will change depending on how many years has passed, but 1 year post acquisition we'd need to prepare the following entry. We would debit accumulated depreciation 6.67 and credit depreciation expense 6.67, so that brings it down to what the parent is recording in their own accounts of 16.67 down to $10 depreciation per year. And then we've got this corresponding tax effect which has been reversed, which is 30% of that. And what that deferred tax asset reversal is doing, it's reversing the above entry where we recorded that $18 deferred tax asset. It's slowly taking that away, and once the asset's fully depreciated, that deferred tax asset will be a credit to $18. Anyway, let's look at what will happen on the next slide, where it's 2 years since the transfer. So here we have 2 years post acquisition, 30th June 2018, and we've recorded the same entry we did as at 30th June 2017 with that debit to retained earnings 42, debit DTA 18, and credit to machine 60. So that brought the asset back down to $90 as at the date of transfer, its carrying amount. Then we've got these depreciation adjustment entries, which are slightly different than what we prepared in the previous year. So we've got a debit to accumulated depreciation of 13.34, which is 6.67 times 2. So in the credit we've got depreciation expense 6.67, which is the current year, reversal of depreciation back down to $10. Then we've got a credit to retained earnings of 6.67 as well, which is the prior year's depreciation. And then as well as that, we've got this tax effect adjustment by income tax expense, which is 6.67 times 30%, retained earnings, which is again the same formula, and then deferred tax asset, which is 13.34 times 30%. So one thing I often find is students get confused with this entry, especially when it's say 3 or 4 years post acquisition, because they're not sure where to put you say it's 4 years, you've got to put 3 prior year periods accumulation to one account and then only the current year to another account. So how I remember which amount to put in which account is, firstly, I think the accumulation account is the total, so how many years since acquisition. So I'd probably start with the depreciation expense for the current year. So it doesn't matter if, always for illustrative purposes we put the debit first. However, when you're writing accounts, if it's easier for you to put the credit first, that's fine. So if it's easier for you to remember that 1 year's depreciation is 6.67 credit, put that first, and then figure out how many prior years depreciation there's been, and multiply the retained earnings by that depreciation expense by that. So in this example it's 1, so it's just 6.67 times 1. But if it's 3 prior years, times it by 3. And then the accumulated depreciation is just the balancing entry, which is made up of both those amounts. And in relation to the next set of entries, we first got this debit to income tax expense of $2. So I relate that to whatever the depreciation expense amount is and times that by 30%. And then same with the retained earnings debit here of 2, I relate that to the above entry of 6.67 times 30%. And then the deferred tax asset, I relate that to the accumulated depreciation amount and times that by 30%. So if you can just through practice or remember some acronym to link up where you multiply the amounts from to determine what the figures are, I'd go with that, because we don't mark you incorrect for consequential errors. So if you get an error, say with the accumulated depreciation amount, and that follows through to your tax adjustment down below, you'll only be marked incorrect for the accumulated depreciation portion, not the deferred tax asset portion. So that's it for transfers of property, plant and equipment. I'd recommend looking at the tutorial questions, because there's a bit more comprehensive ones in there that deal with 3 years or 4 years post transfer, and it's really important to look at them as well. And also what happens if there's a loss on transfer, which sometimes occurs, and there's slightly different adjustments that you need to make compared with this one for that scenario. Now on to the fourth type of intragroup transaction. We look at transfers between inventory and non-current assets. So when items are transferred, assets are transferred within a group to one entity to another, it's possible that the receiving entity classifies the asset differently than what the selling entity classifies it as. So possible scenarios could be inventory being transferred that's classified as plant in the other entity, and this isn't uncommon. It's not uncommon for one entity in a group to transfer some of its inventory that's used for a different purpose, and this is the one we're going to focus on over the next few slides. However, there's also the other way where transfers of plant are used as inventory, and there's an example of that on page 1007. However, we're going to focus on the first one, and we'll go through an example now on the next slide. So, an example on the 1st of July 2007, A Limited sells inventory to its subsidiary B Limited for $45,000, which included a profit of $15,000. B classifies the item as a non-current asset to be depreciated at 10% per year on the straight line basis. And assuming a tax rate of 30%, we need to prepare the consolidation journal entries as at 30th of June 2008. We need to first reverse that whole sales amount of $45,000 that occurred during the year. So that will be a debit to sales as shown there, and then we credit the cost of sales by what it cost the subsidiary, which is we can figure out by $45,000 minus $15,000 stated in the question. And then we're going to credit the non-current asset account, which was, they didn't say exactly what the asset was, they just said non-current asset, so we'll leave it at that. We're going to credit that $15,000, which will bring it back down to its original cost of $15,000. So this is quite similar to doing the consolidation entry for a transfer of inventory. The only difference between this entry and the inventory entry is that instead of saying inventory, we're saying non-current asset. We're also accounting for the tax effect, same again as inventory, where we're debiting the non-current asset credit above, so we're multiplying that by the 30% tax rate and debiting DTA $4,500 and credit to income tax expense $4,500. So that's how you account for the transfer initially. If it was in future periods, you would then need to use the retained earnings account, same as a transfer of inventory, and instead of those income and expense accounts. And we'll now look at, on the next slide, how to account for the depreciation as time passes. So the transfer occurred on the 1st of July 2007, and it's now 30th of June 2008 when we're preparing the consolidated accounts. So the depreciation stated in the question was 10% per year. So that $15,000 times 10% is $1,500, or as it says here, it shows what B is calculating 10% on based on the $45,000, which is $4,500, but from the group's perspective, only using that $30,000 cost is $3,000, so that's another way to figure out the $1,500 adjustment to make. So to do that, it's simply a debit to depreciation expense non-current asset and credit to depreciation expense, which will bring it back down to the group's depreciation amount, and then reversing the tax effect of the depreciation adjustment there. And then in future periods, same would apply as what we looked at with a transfer of property and plant and equipment we looked at in the previous example there. Now we're going to look at the second last type of intergroup transaction for this topic, intergroup borrowings. So it's also common for individual entities within an economic entity to have amounts owing between each other and also charging an interest for doing so. So examples could be trade debtors or trade creditors, and also borrowings as well, such as debentures. And we'll look at an example over the next slide of a loan. So anytime there's a loan of money and interest charged or paid for doing so within an economic entity, it must be eliminated as part of the consolidation process. And also, if there's any, say, accrued interest, so a payable or a receivable, that interest needs to be eliminated as well. So let's look at a simple example here where the subsidiary S Limited loaned $25,000 to its parent P Limited. There was $2,000 interest charged and paid on the loan during the year, and to prepare the consolidation elimination journal entries for this event, we would debit loan liability $25,000 and credit loan asset $25,000, and that reverses the loan amount from both the parent and subsidiaries that are within the parent and subsidiaries accounts. We also then reverse the interest revenue and the interest expense which was recorded in the parent and subsidiaries accounts. So there's not too much to think about when you've got a loan like this. There's no tax effect to determine, so that makes it a little bit easier. However, what usually gets students with this question is when there's, say, a balance payable or receivable as well, such as the accrued interest mentioned or payable receivable talked about in this first paragraph. So if there was an amount to be paid, so say there was a loan made at the, say, halfway through the financial year, and it's paid once a year, so in the middle of the next financial year, that's when 1 year's worth of interest, revenue and expense will actually be physically paid. That means at the end of the reporting period, which is halfway through the year, you'll need to record a payable and receivable amount for that first year of interest that's accrued. So that will be a debit to the payable and a credit to the receivable. And there's an example on page 1013 of the textbook that goes through that. So read the question carefully and figure out the dates and whether anything is still payable or receivable as at the date of consolidation. It's a good one. We like to throw in an assessment question. And last but not least, we're going to look at intragroup transactions for dividends. These are post-acquisition dividends we're going to look at, and they're slightly different to the cumulative and ex-dividends we looked at in topic 3. So dividends paid by a subsidiary to a parent represent the transfer of profits within the group. So of course, from a consolidated perspective, they need to be eliminated. So the elimination entries are required for 3 different events. Firstly, where interim dividends are declared and paid. So during the financial year, say mid financial year, there's a dividend paid. That's called an interim dividend. That's usually declared and paid during the period, obviously because it's only halfway through the reporting period. There's also, however, final dividends that are declared but not yet paid. So they've made a commitment to pay the dividend, however it's not actually physically paid. And then the last one is dividends declared in a prior period and paid in the current period. So following on from the second event there. So assume B, the subsidiary, a wholly owned subsidiary, meaning 100% of the share capital is owned by the parent, declared a dividend of $100 to A. The journal entry in each respective entity would be, for B, they would debit dividend declared, and then they would credit cash, 100. And within A, they would receive the cash, so they would debit cash 100, and they would credit dividend revenue. So on consolidation, as I mentioned before, we never touch the cash account when preparing consolidation entries. We need to reverse that dividend declared, so we'll credit that, and then on the parent side we need to remove that dividend revenue, so we'll debit dividend revenue. You could also just add into that consolidation entry, and in the question there, interim dividend declared, just to, if there was multiple dividends, just to help identify that this is the interim dividend you are referring to. What would happen if instead A only owned 60% of B instead of 100% on the previous slide? The journal entries would stay the same, however we'd go the $100 times 60% and only $60 of dividends would be recorded. Now, as I've mentioned before, for topic 3 and topic 4 we only deal with 100% acquired entities. However, for next topic, if you had a intragroup dividend when we're dealing with NCI, when there's less than 100% ownership, the dividends would need to be multiplied by the ownership percent. Now looking at another type of dividend event where the final dividend is declared but not paid. And when this occurs, there's two types of accounting treatment, and it can vary and it depends on whether the parent recognises the dividend as revenue before it's been received. So the two options are either the parent does not recognise the dividend prior to receipt, or the parent recognises the dividend proposed prior to receipt. And you'll be told in the question, but rule of thumb, because sometimes you're not, assume that the dividend is recognised within the parent's accounts. So we'll look at an example now over this slide and the next, where B Limited declared a final dividend of $100 which will be paid to its parent A Limited in the next reporting period, and we need to prepare the consolidation journal entries to account for that. So we'll look at that, and we'll look at what's going on in the parent and subsidiaries accounts as well. So in the subsidiary B's accounts we have a debit to dividend declared and a credit to dividend payable. So that's recording that the dividend's ready to go. And then on A, the parent side, we've got a dividend receivable and a dividend revenue credit there of 100 on the other side. So the question is whether or not the parent A records that entry, and unless you're specifically told otherwise, I'd record that. So the journal entry on consolidation is the following, where we effectively reverse all four of these balances. As from a group's perspective, there's no liability or asset or income to recognise. So if the parent did not recognise the dividend prior to receipt, just showing you how this example from the previous slide would change when this is the case. So assume that it is, but if it's specifically stated not to, this is what we'd do. The underlying transactions in the subsidiary B would stay the same as the previous slide. However, there'd be no journal entry in the parent A. Therefore, the consolidation journal entry on consolidation would only need to reverse that subsidiary entry via a debit to dividend payable and a credit to dividend declared for $100. This is even backed up on page 1010 that says it's assumed the company is expecting to receive the dividend and the parent recognises it when it is declared, so prior to receipt. Now looking at the final type of dividend adjustment, where dividends are declared in the prior period and paid in the current period. So following this previous example we looked at on slide 47 just before, if A, the parent recognises the dividend on receipt, so in the prior year they didn't recognise any dividend revenue or dividend receivable, they only recognise it when they actually received it, which is in the current year, they would need to perform the following consolidation entry, which would be a debit revenue 100 and a credit to retained earnings. So as I've already mentioned, this isn't very common unless it specifically states in the question that dividends are not recognised when declared and only on receipt. You would need to do this entry. So if the parent had recognised prior to receipt a dividend proposed by the subsidiary in a previous period, there'd actually been no consolidation entry required, and that's because or what's actually going on in the individual accounts are the parent would record a debit to dividend payable of 100 in the current year, and then a credit to cash in the current year, and then the subsidiary B Limited would have recorded a debit to cash and then a credit to dividend receivable. So cash would have changed hands, that's fine, and then they're just clearing the payable and receivable account to zero, so that's no longer apparent. So therefore there's no balances or transactions that really need to be eliminated on consolidation.